Hello and welcome back to the Algo Trading series. Today, in this second episode, we'll see what is backtesting. Backtesting is nothing but testing if a particular strategy works, has worked in the past or not. So, how we can do before dwelling into how we can do backtesting, we will see what are the advantages or why do we need backtesting. So, it saves a lot of time and checks if a strategy has worked in the past. You got say you got a strategy that and you want to check if it works. You do not go directly and execute it or deploy it, right? It involves time cost, money cost, everything, so you'll waste a lot of time and money and energy also. So to avoid all this, we have got something called backtesting. So once we do backtesting, right, we can have some confidence in the system that we can see how much returns it has given historically and what is the max drawdown and all those things we can see, like how much days it took for the strategy to come out of the max drawdown. We'll see all this while doing. We will backtest any one of the strategies and see what are all these parameters, and we can also backtest a combination of strategies, not just one. We can have multiple strategies and add that to a basket or a portfolio of strategies, and we can test that also. And let's see what are the disadvantage of backtesting. One is it doesn't cover slippages. By default, it doesn't cover slippages. We can add slippages and recalculate also. And the most important thing, it doesn't count charges. So this is something I do not know why most of the people do not consider it while backtesting or do not highlight it. This is a very, very, very important thing. If you are a beginner, say you have a capital under 5 lakh, like 2 lakh, 3 lakh capital, and you deploy a complex strategy with a lot of adjustment, then most of the profit will go into the charges. The gross profits will be amazing, but your net profits, there are chances that it may go to negative if your capital is very less. So, and one more thing, back testing does not consider into account is like say you sell one lot of Nifty for like 1.2 lakh, and you encounter drawdown. Say you lost 20 percentage of your capital, which approximately becomes to 20,000, and your capital is like 1 lakh. Now you cannot sell Nifty as Nifty, right? You either have to top up or you cannot trade. Or we can take another example like 2.4 lakh. You're selling two lots and you encounter a drawdown of 40,000, and now you cannot trade. You'll have to trade with one lot only. So the recovery time will double. So those things backtest doesn't take into consideration. And the third point is it is not always guaranteed that the strategy which has worked in the past will work in the future, because there is something called as losing the edge. So when the market cycles change, there can be prolonged drawdown phase, and some say strategy becomes popular and most of the people start using it, and then it can be it can lose edge. So these are the few disadvantages of backtesting, and we'll see how we can backtest. There are two ways of backtesting. One is you can code and get the data and backtest. There are two problems in manual coding. One is like coding is effort consuming when you are testing multiple strategies. If it is one strategy, you can code and you can test it. But if you want to alter the parameter and you want to do different strategies or different parameters, then coding, it takes a lot of time. And the second thing about manual coding is you have to have data. The data, the historical option data is not freely available. It is very expensive. You'll have to buy from different vendors. I have never bought from any vendors. I just heard that it is very expensive. So that is the problem with the manual coding, doing back testing using manual coding. The second one is there are plenty of platforms which have recently come up. Earlier, it was very difficult to find these platforms. Now we have a lot of platforms like Algo Test, Stock Market, Tradetron, Quantman, and many a lot are there. So I'll be doing this testing in Algo Test, and will show you. Maybe say in the future, if there is interest amongst you, I will maybe do video on the other platform as well. So if you want if you want black testing in other platforms, do comment them below, and like the video to show the interest that I'll get some motivation to do back testing videos in other platforms as well. So before doing backtesting, we will have to consider some few things. We'll have to decide a strategy before. We need to have a strategy or basket of strategies before doing a backtest. So the second thing is we'll have to test for a long period of time. It is not like you test for 3-4 months of data and you say a strategy has worked amazing and you deploy that. So you have to look for minimum 5 years of backtesting. So we'll be doing backtesting for Nifty. So the Nifty data is available only for 4 years. So we'll be doing for those 4 years. Bank Nifty it is available, I think, for 7 or more years. So you can do Bank Nifty as well. So then you have to compare different strategies for returns, max drawdown, and days in max drawdown. All those things, risk reward, max losing streak, all these things you have to check. We will while we are doing backtesting, we will see what are all these things, and then slippages and charges also you have to consider. So let us jump to backtesting. So let me open Algo test here. I've already logged in. I'll go to the dashboard. So Algo testing provides a platform to backtest. So it has a free tier where it gives you 25 credits every week. So my credits are over, so I bought some credits to show you how to do backtesting here. So have a lot of strategies which I've backtested in the past. So I'll add a new strategy and we'll show you a simple strategy. The strategy we are considering here is like which one of the strategies which I have explained in the previous video. We will be selling 100 rupees premium call and put in Nifty, and we will keep a stop loss of 25 percentage each leg, and whenever one leg stop loss is hit, we will trail the other leg to cost. So let me change this index to Nifty and we'll keep the underlying as cash only. Of course, we'll be doing only intraday trades. So the entry timing is 9:20 and the exit timing is 3. And will come back to trailing the leg later. First, let us add the strikes. So usually backtest will be done in one lot. We will not be doing multiple lots. So if it is a combination of strategies, then we can go for multiple lots. Since this is one strategy, we'll do in one lot. We'll call a sell week. The expiry will be weekly, and I will select the closest premium as 100. I'll add a call leg, and now I'll add a put leg. So I have added a call and a put. The first thing we have to do is keep the stop loss. So we'll keep the stop loss as 25 percentage for both the legs. We'll not have any take profit whenever 3 o'clock happens. All the legs will be exited, and whatever profit will be there, we will take that. And there is no overall strategy, stop loss, since we have stop loss on both the legs. That will act as the portfolio SL. And now you have to change the date, and we'll start from the algo test has data from Feb, because there is when Nifty expiry started. So let us start testing. The testing takes about 1 to 2 minutes. We'll come back when the testing is done. So the testing has finished. It took less than 1 minute, I guess. So we will see. The first thing we see here, the profit chart as well as the underlying what how how Nifty has moved. Not very sure how much useful this Nifty chart is. So I'm just unticking this. So this is the profit charts. I know it looks amazing. A total profit of nearly 3.3 lakhs. But before looking into the profit, let us see this next chart. So next chart is drawdown. So what is drawdown? Drawdown is nothing but whenever you're in a losing streak, right? You will it shows how much max you will lose. So as you can see, the maximum drawdown of this strategy is about 20,000. Capital required for deploying one lot of call and selling one lot of call and put in Nifty is like there are approximately 1.3 lakhs. So a drawdown of about 20,000 on 1.3 lakhs is huge. It will come, let us see how much it is. About 20,000 on 1.3 lakh will be about 15 percentage, which is bad, which this doesn't even consider slippages and charges. So if you consider that, it will be even more, maybe a 20 percentage fraud. So that is one bad thing about this strategy. So we'll see other parameters. See, this algo test shows us how the strategy has performed month on month. So you can see it has performed pretty well in 2020, 2 months in red, and here in, I mean 2019, and in 2020 like 4 months in red. And yeah, you can see for yourself it gave losses in like 3 to 4 months, and you can see yearly returns as well, in and around, I would say, 70 to 80,000 profits per year. And if you see max down here, right, the maximum drawdown which happened in 2021 is like 21,000. So let us come down and see what do we have here. So this is the overall profit of this strategy. So considering like we have 4 years here. So 3.2 lakh will be, that is 80,000 per year. So if you consider a capital of 1 lakh 30,000, it will be like 61 percentage per year, which is not bad. Again, this is I'm not clarifying the returns of this strategy. It is before charges, before slippages and everything. So let us see other things. Let us keep profits aside, and 969 days of number of trades it has taken. That is nine. It has traded for 969 days, because there are 4 years to 240 approximately trading days in a year. That will come up to 960, and this is the overall profit per trade. So this is on an average how much you will make in a day. That is 338 in a trade. This is the win rate, and the losing, that means approximately in 100 days you will win 62 days, and 37 days you will lose. The next thing is how much on winning days, how average, how much profits you will make, and losing days, how much profits you will make. It is more or less the same. So you will lose the same, you will win the same, but you will win more number of days and you will lose less number of days, and that is how the strategy makes a profit. You need not to consider these two things. So that is like max profit in a single trade or max loss in a single trade. These are not that important. Since we have SLs on both legs, so that max loss will be taken care, and max profit will be decided by the market. Then the very important thing which we have covered earlier, and I'm emphasizing, is max drawdown. This is something most people overlook. This We have a max drawdown for this strategy as 21,000. So as I've explained earlier, if your starting capital is 1.2 lakh and you lost 20,000, you will not be able to trade. So the one thing what I do is always keep this max down as buffer. So if you want to keep max drawdown as buffer in a capital of 1,20,000, you'll have to add a 20,000 as a buffer. Then we have this, so total days of max drawdown. So total days of max drawdown means how this 21,000 loss, right? We went through a period of loss making of 21,000 per lot. It went on for a spree of 62 days. That is, this 62 is nothing but the calendar days. So 40 trading sessions. So we have to calculate the charges for this also. So if you see this strategy, right, if you are deploying this strategy in a broker where it is 20 rupees per trade, then this will cost 130 rupees per day to execute this strategy. So if you consider 130 rupees per day and 40 trading sessions, then it will come like 5,000 rupees. So 5,000 rupees will be your charges. Then you have got 20,000 as your drawdown, and then you have like 1,20,000 to execute this strategy. So it comes to 1.45 lakhs. Let us add 5,000 as slippages, as well as error in calculation. Then you need to have 1,50,000 to execute one lot of this strategy, and so that you don't, even if you go to drawdown, you'll not have to reduce the size. So 1.5 lakh, earlier we calculated like 80,000. as a 53% year before charges. So if you consider charges, it will come like 130 into 240 trading sessions, so that is 31,000. So you make a profit of like 80,000, and you give 32,000 as charges, and this out of 1.5 lakh, this will come to 32 percentage. So even though strategy shows say 60 percentage ROI after charges, you will get only 32 percentage. Of course, you can increase the lot, and then the charges will be almost similar because of the flat brokerage, and you can increase your net returns. So that is why it's always recommended to trade this strategy with minimum two lots. If you're trading into one lot, there are high chances that you will end up most of your profit as charges. So though we have seen how we can manage this drawdown, but 21,000, that is a 20%, nearly 15 percentage plus drawdown is not good, right? So we'll have to see how we can reduce this drawdown. We have stop losses, 25 percentage stop losses on each leg, right? Whenever market reverses, right? So when SL hits, say market goes down and put stop losses hit, and market reverses and come goes up, and then call stop losses hit. So whenever market reverses, right, there is a high chance that it will go and hit your call stop loss also. So what we can do is, if the put stop loss is hit, then we'll just trail that call stop loss. Okay, I'll show it in a Google sheet so that it is easier to understand. So you select call and put at 100 rupees. Now the market comes down and it goes to 120 rupees. Now your stop loss is hit, you lost 20 points in this. And now market goes up and hits your call stop loss also. You lost 20 rupees, 20 points here also. So the total loss in a day is 40 points. So to reduce this, what we'll do, right? So say your stop loss is hit, you will modify this call stop loss to 100. That is the price which you have sold this. So then now what happens is, right, whenever, if say this stop loss is already hit, then market goes up and hits your call stop loss also. Here the call stop loss is at the cost, so the loss in this leg is zero. So even if you say stop loss gets hit in a day, then also you will lose only 20 points. So we will do that in the backtest tool. So if you tick this, right, what will happen is, when one stop loss is hit, other leg SL will be trail to break even. So let us see the date is proper or not. Sometimes this Algo test reset the date. This date is proper. Let us click on start backtesting. So the backtest has completed. Let us see the results. Earlier, if you remember, the profit was around 3.27 lakhs, and now it is 3.12 lakhs. It has reduced by 10,000, but the main thing to consider is the drawdown. Drawdown has come down to 10,000. Earlier, it was 20,000. Now it has come down to 10,000. That is, drawdown is reduced by half. So earlier the drawdown was 15 percentage. Now it has come down to nearly 8 percentage. All we did is trail the other leg to cost. We have reduced the drawdown. But one more thing to consider here is our win ratio has reduced. We will be winning only 54. Earlier the winning ratio was 63, and now winning ratio is only 54. That is like, if you consider charges, you'll be winning like half of the days. But one more thing to consider, this our average profit has increased. Earlier it was 1,500, 1,600 loss. Now it is 1,500 and um, only 1,100 loss. So net on net, we are making 300 per day as profit. Earlier it was around 340 only. I think 20 rupees has reduced, but we have reduced max drawdown by half, which is great, by giving up small amount of profits. Still, the total drawdown days is around 60 only. We were not able to reduce that. We can play around with this strategy and see whether we can reduce the total number of max drawdown days. Sometimes people say the max drawdown is overrated, and total number of max drawdown is underrated, because this you'll have to go through 2 months of not making profit. You might make a profits here and there, but you are in a losing streak, or you are on a drawdown phase, and your psychology maybe get most probably will get affected, and you might end up changing the strategy. You go on Twitter and find what is the best strategy. This strategy is not working. You trade for it for like 15 days and it is in a drawdown phase and it's not working, then you go to their other strategy. That is the main reason why most of the traders fail in the market. Their psychology gets affected whenever they are in a losing streak. They just end up from jumping from one strategy to another. And we have some other interesting facts here. So what I'll do is I'll just download this. We can download this trades as a PDF, and I will run the previous one again, and we can compare those two things. So I have run both and opened it in two different tabs. So left one is with trailing and the right one is without trailing. So if you see this right section, right, there are a few things a few important parameters here. One is return divided by max drawdown. That is your profit divided by how much is your max drawdown. So you want your drawdowns to be less and you want your profits to be higher, right? So whenever this max return divided by max drawdown is higher, that means the strategy is better. So while comparing you two strategies, the right one is without the trailing. Here it is approximately 4 and it's 7.5, almost double. Your that is here the returns are similar and the drawdown is half. That's why the return to max drawdown is double here. One more is risk reward ratio. Risk reward ratio is average profit in winning days divided by average loss on losing days. That is nothing but the risk reward. Here in this strategy, risk reward is almost 1 or zero point 0.9, because you are winning less and you are losing more in profit days and loss making days. The next one is expectancy ratio. Expectancy ratio is nothing but how much the chances of it making profits. Here it is 0.21, here it is 0.29. Any expectancy ratio above 0.25 is considered to be good. So this max streak days, that is a 12 number of trades we will keep winning. We have kept winning in this strategy, and this is a max losing streak, that is 6 consecutive trading days. The strategy has given losses. It is almost similar here. So the main thing to consider here, why the strategy with the trailing is better than without trailing, is this return divided by max drawdown, which is better than the other strategy. So coming to slippages, while testing algo, you have to consider slippages that can be in real execution. There can be slippages that you wanted to enter at 100, you ended up selling at 98, or you wanted to exit at 120 and it got exited somewhere at say 121. So there will be some slippages. So we can consider maybe a 0.2 percentage of slippages, and we can recalculate. So there you can see there isn't much of a difference. So this is the one where we do not trail to the cost. So that was all about the back testing and what to consider and how to compare two strategies in back testing. So if you have any questions, comment them below, or you can ask in Twitter or DM me in Twitter as well. Hope this was helpful. I know it has been a bit lengthy video, and in the upcoming episodes, so we will see how we can deploy this strategy, and we will see how to code the strategy as well. Thank you for watching. Do subscribe to the channel so that you don't miss any video when I upload them. Thank you.